So, David Keller. David Keller. So David was very kind to have me on his podcast a couple weeks ago, and I have to say, he probably did the best job of anyone at interviewing me, and it was a great conversation. And I was my usual manic self, so I think David was. I think I could say amused. At any
I
rate,
think I remember you talking about him.
yeah, no, it was terrific. And so David and I, he'll actually remind me of the year because we both worked at Fidelity, but we didn't overlap. So I'll let him recount the story. But David and I have known each other, oh, I gotta say, probably going back 12, 14 years, something like that now. And we know a lot of the same people because, we were both in Boston at one time. And, I'm now in Westchester and he's up in the state of Washington. And I was jealous. It was like 99 here. When I talked to Dave this morning, he said it was 58 where he was or something. So anyway, Dave's a great guy. Everyone should watch his, and I'll put it in the nest. Should watch his market misbehavior. He's on every day, talk about markets, interviews a lot of people, and aside from just being a really smart technician, he's a great guy. He's a nice guy. There are a lot of clowns in this industry. So, David, welcome. Please unmute yourself.
Hey, good to be with you, George. And I would echo the comments on your epic music choice at the intro. I was pleasantly surprised at the kickoff here.
Well,
Yeah, it
it could
wasn't it wasn't boomer music.
it was okay.
I had very
I
low
did too. I was like,
expectations. They were exceeded.
George is
Well
taking
done.
us to the club.
Hey, Dilly, all right, Dilly, you know what? It's part of my brand. You're my brand manager, Dilly, so maybe I just got to get Jared's playlist and we'll just go with that from now on.
Hell yeah,
Otherwise,
that sounds good.
otherwise it's just more boomer music. All right, all right. So David, monetary misbehavior. Amen. That's the name of your show, is it not? Monetary mis, or is that I can't. Where we? I don't know. Yeah.
You
So
you you riffed on my title. My
uh,
channel's called Market Misbehavior, but there's all
yeah,
sorts of misbehavior happening here. We can have all sorts of
exactly.
adjectives.
So, David, let's start this way. Instead of doing the usual blah, blah, blah. So, David, what do you think of the economy and markets? Okay. So, David, we're seeing things, in my humble opinion, this is just me. Maybe you're better than I am. But I've been at this since 81. We're seeing stuff I've never seen before. All right. And not only that, investor attitudes. I mean, this is an example. The people are applauding the fact that SPACs are coming back. I'm like, what? I'm like. I mean, the amount of financial. I got to control myself because we're only 5 minutes into this. I'm already getting amped up. But the amount of financial illiteracy that's out there, and people are just. I mean, it's like. Do you ever feel, David, that some of the rules you grew up with, first principles, which served you so well for so many years, like now you kind of wish you could just unlearn them because it's. I mean, I know it's just. And I hate to talk about things like valuation fundamentals. The nice thing about you is charts don't have opinions; they're just objective reality. So,
That's right.
yes, so David, start off. I guess what really catches your eye right here, or what's really noteworthy or striking, or your strongest held convictions? Because we're all confused. Everyone's constantly buying high and selling low, and wash, rinse, repeat, as I always want to say. But
Yeah.
I've used the line multiple times now from this screenwriter William Goldman. I think I used it in our podcast together. Nobody knows nothing. It's just like what the huh. So, so David, what do you believe in right now? What's noteworthy? What's eye catching? So go with that, whatever you want.
Yeah. I mean, these are in some ways very unprecedented times. I mean, if you think about what all the things that we've experienced in 2025 as investors, the amount of subject areas. I mean, if you told me years ago I would need to be an expert in the Strait of Hormuz and shipping patterns, I would question that. But that's the reality of 2025, and just understanding the potential ripple effects of so many different things. I think the great point about charts, as you mentioned, George, they don't have an opinion, right? And so charts are designed to help you understand where the collective psychology of investors is going. And as much as these are unprecedented times in terms of headline risk, in terms of tariffs in a way that none of us have ever experienced, geopolitical risks that have, exploded, literally and figuratively here in recent weeks. I mean, all of those feel like one-off, unusual, new experiences that we have to kind of parse through to figure out the potential impact. But I would argue that these are all very familiar themes when you think about investor psychology, when you think about human behavior, when you think about the fact that for years, I would argue the investors investment. The markets have been driven by emotion, primarily fear, right? Where on the downside, it's the fear of losing everything, it's the fear of things going to zero, it's the fear of tariffs completely disrupting the entire global economic situation. On the upside, it's FOMO, which we're, I think, experiencing, even through this week, right? This fear that you're going to miss out. And if you don't buy it immediately, you're going to miss out on, the market moving to new all-time highs and beyond. So as a technical analyst, it's a great reminder of sort of the consistent message you can get by digging into the message that the markets provide back to us in the terms of in the form of price action. So I think for me, it's a great reminder that if people are nervous and if people are anxious, and we're seeing that sort of volatility day to day, paying attention to the charts and how they evolve, I think is an incredibly valuable set of tools right now. Um, from a market outlook perspective, I would say at this point, I kind of think of this market as having one sort of general sense, and that's the market moving higher on weaker internals. And what that means is there are a lot of ways we can, analyze the price of a stock or ETF, that we can analyze the trend in the S&P or the Nasdaq. And a lot of those are trend following tools to just define the trend and just recognize what's happening. And by any definition, besides certain sectors which are not doing particularly well, on average, the markets are doing quite well, obviously, right? And the S&P is rapidly approaching a retest of previous all-time highs. But sort of any measure that I would use that I would consider a market internal, whether that's measures of market breadth, which is, looking at all the individual companies and what they do, whether it's looking at price momentum, so how the market is getting from point A to point B and the momentum behind that move, whether it's looking at volume, I would say all of those things have been weaker from May into June. And so we have this situation where the indexes are moving higher, but any sort of measure that we would use to validate that, none of those are supporting the recent up move. And so I would say that that kind of ends one of two ways. Option one is the price of the indexes comes down, and the weight of that, that lack of upside, support starts to weigh on assets, and so risk assets start to rotate lower, or all of those internals have to start improving. We need to start seeing moves higher on stronger volume, stronger momentum, and stronger breadth. And either of those things could happen, but it certainly seems to me, in my experience, when you see those weaker internals, following the internals is the most important thing, because that's really the test of how investors are voting with their capital. The indexes can do a lot of things that are explainable later once we have a major reversal and we go, oh yeah, those were all the signs of a top that are really clear now. So for me, I'm pretty cautious, given the fact that anything I would use to validate the recent upswing, I would argue, not particularly strong. Does that make sense?
Right. Yeah, no, no, you really cogently put that. Because it's funny too, as the market grinds higher, and you know this, David, and it's a good rabbit hole to go down. I want to go back to the Fidelity chart room,
Sure.
and I want you to talk. So I want you to describe the Fidelity chart room, what it was like, what your role was there. And in particular, I want to get to the point about how we knew this at Fidelity. I mean, you've heard the phrase, you've probably used it many times, sentiment follows price. And so we would
Mm,
see the inflows, like you see we could see it like the select funds and all that other stuff. It's like, nobody wants the stuff when they're on sale. Curiously, as they always say about stocks, it's one of the few assets where as the price goes higher, people want more.
mm.
So using that as a trigger, to trying to trigger you. So could you talk a little bit about Fidelity? And I mean, it's really a chart room unlike any other, and talk about what that was like, and when Ned would come around, and
Yeah.
Bob Hill's not with us anymore, and others you've worked with. I mean, it really was a very special place. So I think people would love to hear about that, David.
No, for sure. I'm glad you asked, George. The Fidelity Charm is a really special and really unique place in the financial industry. It is a physical space dedicated to analyzing market history visually, right? So really focusing on the message of price action and sentiment, and really celebrating the value of technical analysis to help us just define what's happening. And the markets and certainly the charts provide an amazing history lesson. It's a great myth buster. Mark Dibble, who's someone you and I both know and have worked with. Mark was one of my senior analysts, and he would always say charts are the truth serum for the markets. And so I feel like going to the chart room and spending time there was a great just reminder of what had happened, and learning the history of the markets through visually understanding how things had evolved. And no matter what new thing would come up, it would rhyme with some historical period. It provided us a great opportunity to sort of learn lessons of cycles past. So the Fidelity chart room really started, oh, probably 80 some years ago. This is in the mid 1900s when the first Edward Johnson II, right, the first fund manager at Fidelity, created this space, and then a series of analysts, Bill Doan and others in the 60s and then into the 70s, were the head of this market research department. And back in at that period, charting was really a very manual process. So he would have, Bill Doan, who I knew and met with before he passed away years ago, would talk about how he had a whole team just to go through Barron's or whatever data sorts they had and hand update, prices in an accounting ledger and calculate moving averages and logarithmic plotting, and then hand draw with colored pencils all of these charts. So the benefit you had with of a chart room in the 1970s, which you just had these huge wall-sized charts that no one else had, and you had the opportunity to literally immerse yourself in the markets and to look and understand and see what was working and what was not. Um,
Yeah, David. It'd be really cool. You should put it up on your website or tweet it or something. If I don't, I mean, there must be some pictures. You must have some photos somewhere what the chart actually looked like, just so people understand.
yeah,
It wasn't
yeah,
just they had these enormous, 6 by 6 charts up on the walls, but they would have these things that would like swing out. It was almost like when you go to like a poster store or something, or you're looking at greeting
yeah.
cards, and they have these things like these carousels, and you can like flip it from one to the next. I mean, David, there were like literally hundreds of charts in that room, weren't there?
We at the peak, so I was there 2008 to 2016. We were in the process of digitizing a lot of the paper charts that had been in the room for decades. At the end, I think we had 280,000 individual charts that we managed, and
What? Two hundred eighty
yeah,
thousand?
yeah, in an electronic repository that we would keep updated. I mean, it was a ridiculous resource. I mean, it was just fascinating, but so helpful. And a lot of that, I mean, things were stocks that weren't trading anymore. But you could go back to the 74 low. You could go back to 1983. You could go back to
Yep,
pivotal periods and
yep.
really think about what struggled during that phase, what led
And,
on the way out, and all of that.
yeah, and we'll get Gnostic in here in a second, but before we do that, I want to keep this going. This is great. And so one of
Yeah,
the really cool things I remember, people might not appreciate this. So Ned Johnson passed away just a few years ago. He
yeah,
he was a fund manager, just so everyone knows, back in the '70s, along when Jerry Sy was actually at Fidelity, in the go-go
yeah.
years. And Ned, even though he was running the company, he would. I mean, I don't know you if you were the designated hitman or whatever, but it was so cool. Even though he was just managing, this multi-billion-dollar empire, he would still come up and walk through the chart and go like, "What about this? And what about that?" And it was really cool. But you know what else was interesting? I don't remember Peter Lynch spending hardly any time in the chart room. Do you?
So you're absolutely right on all those counts. Peter was not a big consumer of the chart room. I mean, we at the time I was there, we probably had 75 portfolio managers in the equity space we were
Yep.
we were working with.
Yep.
Um, and there were a group of probably 15 to 20 that were heavy users that were in there all the time,
Hmm.
met with my team regularly. There were a handful that very rarely, if ever, did. And then there were a big group in the middle that probably could have used it more. And Peter was kind of in that group
Yep.
where he did not use it often. I mean, he was much more focused on the fundamentals, on the stories and the
Sure.
themes, and which is totally fair.
Yeah, yeah, yeah,
Um,
yeah. Peter didn't pay
yeah,
much attention to macro or the charts.
yeah.
Let me ask you. I mean, we won't get in trouble, but did Abby come look at the charts much? Abby Johnson?
N- Not as much as her father, Ned Johnson. Ned was, I mean, Ned could not get enough of the chart room. He was
Right.
there when I was there. He would come in every 6 weeks or so. We would get
Yep.
about about 3 minutes warning, and we literally had like a hotline phone that would ring, and it was the he's on the elevator, and I would grab one of my analysts and we would like tear over there, and
Yep.
we would spend 2.5 hours, and it was. I mean, George, those were the most stressful discussions. I mean, I mean, he was just smart. I mean, sharp as a whip when, I mean, at his peak, would
Yep.
just ask these brutally deep questions
Oh
about
yeah.
market history and dynamics and
Oh
how
yeah.
does this compare to this? And it was, I mean, wonderful. And looking back, I mean, it was just a fantastic, walk
Well,
through market history.
yeah, and I think that was also important in terms of define the culture of the firm. He was
Sure.
curious, and he certainly was not an overly officious or administrative type. So he was
Yeah.
always curious and always willing to try new things and look at a bunch of other stuff. So hold for
Yeah.
1 second, David. I want to we're going to try to earlier than usual make this more of a dialogue. So Gnostic,
Sure.
my friend, you wanted to weigh in? You got a question or observation for David? Gnostic, please unmute yourself.
Oh yeah, I mean, I was, those chart rooms were just absolutely amazing. I had basically was part of a company that manually did those charts on a regular basis, both for New York, Amex, and the Canadian markets. And what's really interesting is, the momentum. It just gives you an insight into the momentum, how stuff is working,
Mm,
removes you from the panic of the moment in the market, but it gives you an insight into what's going on in a history that just the fundamentalists just don't have any idea where it is. And the guys that drew those charts actually had a really intimate, like we're talking doing this manually on drafting tables,
Yep.
yeah.
and
And
they
that's
had
yep.
they had the most intimate understanding of what was going on with that market, almost as good as almost better than floor traders because it was a better breadth. But the floor traders were the only people that had the on the floor feeling for what like the intensity, everything else that was going on in the market, and they could tell you how the market felt just by the noise in the room. the
Mm,
the, the traders, the people who were drawing up the charts could do somewhat the same thing but a little bit more removed, but they also had a more historical view. The traders knew it day to day, minute to minute, second to second. The chartists knew it a little bit more with a little bit more history, like you were talking about. You could go way back and sit down and do it, but they got to almost as intimately know the company and the movements of the market and the momentum that would happen in the market that the fundamentalists and even the floor traders didn't have. And it was such a valuable tool. And then the computers came in, and just
Right.
the intimate knowledge just
Yep.
was gone because
Yep.
now it
mm,
was
Yep.
all
Yep.
mechanical.
Yep. Okay. So now that's a great point. So David, I'm going to go right at you.
yeah.
So you remember Justin Mamus?
Sure.
Okay. So Helene Meisler, who was his
Yeah.
sidekick, still around,
Yep.
and Helene's still. I always want to call her Helen, but it's always Helene.
Helene. Yeah.
How many other Helenes do you know? I mean, you got Mount Helen up where you are, but how many Helenes do you know? So anyway, Helene would insist, and she always makes a point about when she presents about plotting the charts by hand, and she would
Yeah.
maintain. There is a question here. She would say, "There's no substitute. When you hand draw the chart." To Gnostic's point, there's an intimacy and a feel that you get that is just not the same when you're looking at some screen where it's electronically displayed. Agree?
Yeah.
Disagree? Agree? Disagree?
100% agreed, and I think the points are all totally valid. I remember Louise Yamada, who was at Citigroup as Smith Barney. She was one of the technical analysts. She worked with Alan Shaw, who was one
Yep.
of the top, analysts on the street back in the day. And she would still, I mean, she would come up to the chart room. We would meet with her, a couple times a year, and she would bring out these big, paper point and figure charts that she'd been keeping of the Dow stocks going back 40 odd years, and she'd unwrap this big paper and kind of show us. And when I was, sort of learning technical analysis, I remember hearing from mentors, and there were a number. Like Louise had mentioned this, Ralph Acampora, who was one of my mentors, had mentioned that. Bruce Kamick, who was at a number of
Yep.
shops, they all mentioned, look, if you really want to understand the markets through charts, you
Right.
have to draw them. And Ralph told me back in the day, being a technical analyst was really being a chartist because 90% of his time was just updating the charts and
Yep.
bringing them up. So when I was learning technical analysis, I kept by hand charts of the S&P, the NASDAQ, and then the Dow 30 stocks. And I would do bar charts every day. And then once I learned point and figure charts, which is a different methodology where you're tracking trends going up and down,
Hmm.
I would keep those by hand as well. I don't know if I've ever felt as connected to those charts and those stocks as during that period where every day you would go in and literally just updating it by hand, you really understood. It was so hard to miss when something was changing, right? It would be so clear when a period of accumulation was over and
Right.
when you started to see these down days and you would see the distribution as you're drawing the line, you would recognize that something had changed.
Hmm.
And my generation were kind of the first group of technical analysts that did not have to do it by hand at all. So I started in the industry in 2000. I learned it all electronically. And I'm
Right.
so glad that I went back and at least you spent some time doing that because you really understand the lines and the flickering ticks you're looking at
Yep.
on the screen. They really
Okay.
represent the interplay between fear and greed. So I wholeheartedly agree. Good lesson for people just getting started. I think that's
Yep.
still
All
so
right.
helpful to connect with the markets.
100%. All right. Let's move a little further afield. And Dilly, I'm almost thinking you should tweet something out ridiculous. Like there's such gold being dispensed here by David. I don't know, Dilly, if you should like put something out that I don't know, someone's running around the space naked or something just to draw a crowd. I don't know. It's just like this is like anyone who cares about markets should want to pay good money to hear what David's saying. But I digress. They just want
George, careful. She'll say you're running around naked and everybody will leave.
100%.
to.
100%.
That would not be a good look. All right. So, so David, let's go to the here and the now. So let's talk about the
Yep.
market. We know the market. It's a market of stocks. Maybe one of the. So you said breadth is narrowing, not a good sign. You think it's going to end one of two ways. I tend to agree with you. It's going to end the not so good way.
Yeah.
So where's the real points of vulnerability if you're looking to go short, and where's the relative strength right now? And by the way, David, I did put in the nest the two things you sent me.
Oh,
So
great.
people can see that in the last. I'll just call this out in the last couple of months how tech has really led the way, and it's what you want to see in a bull phase because you have the defensive stuff, Utes and Staples being the laggards. Okay,
Yeah.
and then the other one, I think. Hold on, what the heck was this? You had different lines up here, different indices. I can't even read them; they're so small. But anyway, knowing that you have those tools at your disposal, so talk about trying to help people in the room at home. What should they be looking at? What should they be? Maybe people want to short, but what should they be kicking out if they happen to own it?
Yeah.
A lot of the crap's falling too. It's like it's unbelievable. I mean, some of the biggest dreck is going up the most. So, how would you think about if your best friend, not your mother-in-law, but your best friend, you'd say like, buy this, don't own this, short this. Like, what? You don't have to get too granular because again, this is not financial advice. I'm not giving people picks, but just sort of thematically, factorially, cap-wise, et cetera, geographically, even you may say, well, hey, the farm markets are better in the U.S., which they are. So I don't know. How
Yeah.
about it, David?
Yeah.
Go at any part of that you want.
Yeah, so one of the things you post, and I appreciate that you posted those. I mean, one is just looking at sector returns over the last 1 month, right? So I was really just thinking since the April low, how has this market evolved? And obviously we've had a dramatic upswing, but if you look at the last 1 month, only two of the 11 S&P sectors, only two have actually outperformed the S&P. And I remember, George, these kind of markets at a shop like Fidelity, where you're stock pickers, these are not easy moments where the market's going higher. We would always say this is one of those where you get the market call right, but you're not getting paid for it because unless you own these small subset of names that are doing quite well, if you're diversifying away at all from those, you're probably underperforming with the rest of your portfolio. So, over the last month, tech is up about 10%, communication services up about 5.25%, the S&P is up about 5%, everything else has underperformed. And so financials, which at times have done quite well, lagging, materials, industrials, and just everything. And so I think this is a challenging market in that you can be in things that are doing okay on an absolute basis, but on a relative basis, you're really struggling. So I think for me, one of the big, sort of key bullet points is the importance of relative strength. And that is a well documented technical analysis tool where you focus not just on absolute returns. You don't just focus on price and price movements. You focus on how a particular stock or ETF is performing relative to all the other stocks or ETFs you could be buying at any given point. And generally speaking, my goal as an equity oriented investor is to own things that are outperforming. And one of my great analogies, or my favorite analogies, comes from John Roque, who you and I know. I know he spoke at your event recently. He's awesome. I mean, just a fantastic technical analyst and market historian. And he came up to Fidelity back in the day. He's a big Yankees fan, has this fantastic New York accent, came up to a room of Red Sox fans and said, "All right, you're the manager of the Red Sox. The Yankees are at Fenway Park tonight. Who are you going to put on the field to give yourself the best chance to beat the Yankees? Are you going to put on your hitters that have been struggling, the guys that like should be doing better but just have not been hitting well, that aren't fielding particularly well, a lot of errors? Or do you put the ones that are at the top of their game, everything's clicking, they're hitting well, they're throwing well?" And it's so obvious, right? If you're managing the team, you put your top performers. That gives yourself the best chance to do better. And so, why would you do anything else with your portfolio? And I think if there's one lesson in the markets in 2025, it's really having an aggressive focus on relative strength and focusing on things that are helping you do better than a passive product. And if you look at those trends, I mean, technology is by far the top outlier. And I would say, as a contrarian, if you look at valuations and if you look at how far a lot of technology names have come, it's easy to justify how they're overextended. It's easy to document how they're overbought, right? Which is a technical form of just extreme positive momentum, which tells you that at some point that theme's not going to work anymore. But as a trend follower, which I think most investors probably should do more of, you want to follow things that are working until they're not, right? Peter Lynch, the famous, water your flowers and pull your weeds kind of thing, right? We want to water our flowers and nurture the positions that are doing very, very well. So while I could explain why semiconductors may be overvalued, why I could tell you why things that have had incredible runs at some point have to have a meaningful drawdown, even to continue their uptrend, the strength in those trends is very, very real. So charts like Microsoft, sort of those up and to the right, long and strong charts, regardless of what you think about valuations, I have learned to stick with something that's working. And your goal in a chart like Microsoft or something like that is to remain invested as long as possible and to use good money management techniques. You use trailing stops, use the part of the technical toolkit that helps you unwind when you finally detect some distribution, and just wait for those signs to come and follow them as long as possible. So I think the strength in technology, for a lot of reasons, probably continues. I think even if there's a big, pullback for the broader markets, which I think is certainly possible, and even likely going into the fall, I wouldn't be surprised if something like technology still ends up outperforming in a meaningful way, because these are names and themes that have staying power, and they're charts that in a lot of ways have been good offense and good defense, which is kind of the ideal situation. So that's one thing that I have. I To the other side of that, and you mentioned, George, looking at just the last month. I mean, the worst performing sectors have been some of the defensive sectors, and there was a period earlier this year where it looked like consumer staples were starting to emerge, and some of them have, like tobacco names, have been overall pretty good. But generally, that sector has struggled. Utilities, which has kind of a growthy feel with all the energy requirements of AI and cryptocurrency mining and so forth, are lagging over the last month. And one of my most effective ways that I found, and this really came from years in the chart room, of how do you identify when a market uptrend is exhausted? How do you validate that the go-go moment is no longer good and that you need to start getting defensive? And looking at the relative strength of defensive sectors has been by far one of the most consistently helpful metrics, because until and unless big institutions are rotating to more defensive positioning, until and unless people find value in owning low volatility, higher income, dividend paying kinds of names, there's just not a lot of reason to be too defensive. I think we generally want to be looking for kind of the next big breakout. So for now, the relative performance, the relative strength of those defensive sectors is still pretty weak. At some point, those will start to improve. And I have a chart that I just follow the relative performance of consumer staples, utilities, real estate, and healthcare. And those are those four kind of key defensive sectors to watch. When those relative lines start to rotate higher, that's when I have learned you want to start to get defensive. Um, Last thing I would say, because you gave me kind of an open mic night of market outlooks, the third thing I would say would be the seasonality. What's really funny is sell in May and go away is something as investors it's often thrown around, and for good reason, because over the long history of the markets, selling in May and buying in November has generally been a pretty decent approach. But post COVID, that's actually been a pretty bad strategy. Buying in October, November has been pretty good. It's selling in May that's been way too early. So the market's not topped out in May in quite some time. It's topped out in June, July, August. And so the summer months have actually been remarkably strong. So the fact that we're seeing so much strength in June actually tracks the last 5 years pretty well. June is a pretty good month. July's been a pretty good month. Even August has been a pretty decent month. It's September and October that have been consistently bad over the long history, but especially in the last, kind of post-COVID years. So I wouldn't be surprised if there's a significant drawdown to be had. I would not be surprised if that's in the fall going into a major low, because it is incredibly rare for a year to not have that particular contour. So what you want to do between now and then is look at those signs for potential deterioration. Look for defensive sectors starting to improve. Look for breadth conditions to deteriorate. Look for volume to dry up or distribution, signs of big volume on down days that would all tell you that that summer peak we've often experienced is starting to happen.
So it's game on, basically. That's really, it's quite a review. Let's move a little bit further afield, David. And if you don't have strong feelings, that's fine. But any thoughts on the dollar, fixed income, or commodities and gold?
Oh, for sure. I mean, if you think about all the, from it as a technical analyst, right? My goal is to look at the charts and to just follow the trends. And if people are nervous about the Fed, if they're optimistic about, inflationary pressures easing, I would argue the charts are going to reflect that. So focusing on those metrics that we discussed are key. But I would say in 2025, if you really want to understand the relationship between what's happening on the charts and how those trends are evolving versus the sort of macro forces that would create those trends you're expecting, I think you have to look at the dollar. I think you have to look at the fixed income markets. You have to look at commodities, and I would say in order. The weakness in the dollar pretty well documented from a technical perspective. It's hard to describe that as anything but a confirmed downtrend phase with some random kind of bounces higher, but generally that's it's in a period of distribution. And I think that speaks to a number of things, but what it does not imply is that a bunch of investors outside the US are converting to US dollars to buy US debt. Because if that would be happening, the dollar's going to start to strengthen in a pretty meaningful way. So I think, along with like a rally in defensive sectors, I think watching the dollar for any sort of big reversal could be a really important, sort of macro theme to pay attention to. I would say from a fixed income perspective, the bond markets are always super valuable. And again, from time of Fidelity, bond investors, anyone who had experience with the fixed income markets, just had such a better sense of risks. As equity investors, we tend to be way more focused on reward and less thinking about risk. Bond investors think way more about the risk because they're just thinking about companies' ability to meet their debt obligation. So I've found risks will often be reflected in widening credit spreads, which we haven't really seen, right? We got high yield spreads are actually pretty narrow right now. Look for a spike higher there, or a widening in spreads that would imply some concerns. We're not really seeing that. So I think that's a second certainly area of the market to focus on. The other one I would say with that is just looking at the 10-year Treasury yield from a technical perspective. We're potentially breaking down. We've pulled back here recently as the bond markets have rallied a bit, and the 10-year yields testing support. A breakdown in interest rates all of a sudden starts to make home builders a really interesting idea. That's sort of always in the back of my head when I see the 10-year yield coming down, I immediately look at the home bill like an XHB or ITB or one of those, and just looking to see how DR Horton and Lennar and NVR and others start to improve. Those do well when homes are less expensive, and so that's one important metric to watch as well.
Got
And,
it. All right.
yeah, and then gold. I would say from a technical perspective, gold has been, I mean, by far one of the strongest charts in 2025.
Sure.
And again, I think as long as those trends persist, I have a big position in GLD and IAU, and I'm not selling it anytime soon.
Great. All right. So, Tommy, you were here and then you disappeared on me. Let me get you back in here. Um, Maybe he's got a phone call. David, did we touch on energy? I don't. My mind scrambled. What do you think of crude? That's a tough one. I mean, do you have a view on energy stocks?
Crude is a noisy one. And I would say within the energy sector, I mean, so many have thought of energy very simplistically, which I get, right? I mean, you think of the energy sector, the XLE, as being driven by crude oil prices. So if you think crude oil is going up or down, that's kind of your thesis, right? For most of the energy sector. I think remember that outside of the big integrated names, outside of the oil producers, you have infrastructure names, and those have been the names that have been quite strong through most of 2025. Natural gas names, pipeline names, and I would say from a technical perspective, those are still the ones that are by far superior to Exxon and Chevron and ConocoPhillips and those kind of charts. Those are going to be very directly tied to the price of crude oil. Crude oil is incredibly volatile given the rapidly
Got it.
evolving situation in the Middle East. Overall, I'm skeptical of sort of the big integrateds until you see more technical improvement. I'm more into infrastructure names, which have been much stronger.
Got it. Let's go to Tommy if he's back, and then we'll go to Van. Tommy, you there, my friend? Please unmute yourself.
Yeah, yeah. Hey, George. Hey, everyone. Hey, David. I am sort of a fan guy of yours. I've been a long-term subscriber to StockCharts.com
Mm,
and followed your work. I have had StockCharts.com, I think, since 2000, and I use it every single day. I look at relative strength, at a lot of the internals, and one of the things that really has helped me is focus on some of the market internals.
mm,
My question to you is, what internals do you look at for the most overbought and most oversold with a fairly for example, if you see something, let's say the percentage, I look at the percentage of stocks above the 20-day and the 50-day.
yeah,
In April, these things got super oversold, first time in really quite a while, and it gave me a lot of confidence to get in there and buy. What do you look at on the upside and the downside? What are your little secret sauce type things just between
yeah.
us?
No, really good question. I appreciate that, and I would say, yeah, with stock charts, one of the strengths is the amount of breadth data and just ways of tracking conditions, sort of the second level, right? Like underneath the hood of the markets. You had mentioned a great set of indicators, which are the percent of stocks above key moving averages, right? So you have, and I think of them as three parts. You have the percent of stocks above like the 10-day or 20-day, which gives you a really short-term swing. John Roque and I talked about this when I had him on my podcast. We talked about that as a short-term gauge, and 100%. I mean, they were completely bombed out at that April low. I mean, looking back, one of the great sort of indicators of a washed out, completely negative breadth situation, which really suggested that there was, basically one direction the market could go from there. But then you have others, right? You have like the percent of stocks above their 50-day, which is a little more medium term, and then you have the percent of stocks above their 200-day, which is more longer term. So I have found with things like that, particularly at a market peak, looking for divergences, not just when they're at extreme levels, but when you see the market moving higher as those indicators are getting weaker. That is often a really good gauge of maybe a warning sign that's not as clear looking at the chart of the S&P or the Nasdaq, but is clear if you look at that kind of metric. So that's one. Another one I would say that's really helpful is the bullish percent indexes. So I mentioned point and figure charts earlier. This is a traditional charting methodology where you draw X's for uptrends and O's for downtrends, and it's a really simple way of just charting trends upwards and downwards. There's all sorts of rules you use to create these using the traditional methodology. And then these breadth indicators called the bullish percent index basically look at hundreds of charts and say what percent of this group of charts have a bullish point and figure chart. And when you see those, the bullish percent index above 70, 75%, that tells you kind of almost everything is bullish, right? Everything's going up. And it's kind of the opposite of what you mentioned seeing at the April low. All of a sudden, that starts to feel very frothy, where kind of everything's starting to work. So, one of my favorite tools has been looking for when those indicators become very high, but then start to rotate lower. And that's one of the things that I've seen just in the last week or two is you've seen those bullish percent indexes on the S&P to a greater degree for the NASDAQ 100, going above 70% and now, diverging, meaning they're making lower highs and now breaking down below 70%. And I think the NASDAQ 100 is a really key group because obviously that's the Magnificent Seven and friends, right? Those are the big mega cap growth stocks. So if those are actually getting sell signals on their point and figure charts, that means something. That tells you that a lot of names are actually already starting to break down. And what happens is that usually starts to rotate before the major indexes start to rotate lower because there will be enough stocks going up. It's able to hold the index values higher. So those are two, and that's one that I found particularly at market peaks. If you go back over time, has been relatively valuable. So when I think about things that concern me right about now, the bullish percent indexes having gotten very overheated in May into June, and now coming down in the last couple weeks is an area of potential concern for sure.
Yeah.
Yeah, wait,
So
hold on,
Tommy,
George,
no,
one sec.
Tommy, hold on, because you weren't in the room for the first half hour. Just to fill you in, David is large. Tommy, you and I met the other day. David's largely in line with your views in terms of narrowing breadth, and it's not looking so good. It could resolve itself down or up, but he's in your camp, Tommy. So I just wanted to contextualize what he was saying,
Mm,
just so you know. That's a
The
go ahead, Tommy.
the when the bullish percent on the NDX hit 6 um, in April, I figured, that's, and the S&P was at, I think, 12, and
yeah.
these are levels. I look at a lot of technical indicators, and I say, well, what did it look like in 1998 after that market crash? Look
Mm.
like in other periods, and how did all these things line up? So I have, you know 25 different indicators that I look at, and if everything is getting to one side of the boat, I tend to use that as my context for either getting long or short. And I think that I think the stockcharts.com stuff is great. I'd love to chat with you offline about a couple of things that I would like to see. But just great work. So I'll leave it there.
Let's say, Tommy, thanks so much. Really appreciate that. So, Nas, give a quick follow up, and then I think Van has a few words. He's got a rare moment of sobriety. So, Nas, to keep it quick, because I want to hear from Van.
Oh yeah, that's it. Edit me before I
No,
start, George.
Nas, Nasa,
Anyway,
you can't pull it. You can't pull a George into a filibuster because not
uh,
Van's usually not sober. So I'm glad he's here. Go on,
oh, you're so sensitive when I pull your leg,
go
George.
on, Nasta.
Anyway, David, uh, have you considered calling those the first and second derivative velocity changes? So change in velocity, change in acceleration of those two things, which has always been indicative of something happening. The second derivative being more sensitive than the first derivative, but essentially you're talking about changes in velocity at different things, both velocity and acceleration, and those have always been indicative of a marketplace. So when you're talking about them, all I want to do is translate it into first and second derivatives and what that means. Have you looked at it that way?
100%, 100%. And I would say in the technical analysis toolkit, I mean, with most things, we love to simplify, right? And I would say in the technical analysis toolkit, people love to look at very simple measures of, what level is something at? Is it overbought or oversold? Is it above or below a certain level? Most things that I look at, like, and even something as simple as moving averages, the level of a moving average is the most basic, piece of evidence. The slope of the moving average, the rate of change of the moving average, to your point, sort of the, velocity, the acceleration, that's where really the signal is. That's a level that most people don't want to get to because it's a little more complicated and you have to think a little bit more. But that's where I think the real signal is. And I would argue, not to completely derail what we've talked about, I would say even looking at something like earnings. I mean, I've talked to people that would say it's less, how earnings estimates have changed. It's the rate of change of estimates that's more meaningful. And I would say that generally is the case. So if I'm designing a kind of trading system based on technical indicators, I immediately look to different ways of weighting the data, looking at more exponential weightings because that weights the more recent data a little more heavily. And I look at things like the velocity and the change and the acceleration or deceleration, and that is often where the changes will become reflected much more quickly. I just avoid using those terms. That's probably from years working with. I don't want to. I want. How do say this very nicely? People that are not open to too technical ways of describing anything. So I had to simple. I use language that resonates. I use words like rich and cheap and very simple terms just so it resonates with the right people. But I think I would 100% agree with where you're going and where the signal often is.
Fantastic. Van, are you still awake, or you kind of passed out here? What's going on, Van?
No, no, I'm here, George. Can you hear me? Okay.
Yeah. So Van, I mean, Big George always taught you to use the charts. And I know a lot of your research consists of have a hunch, buy a bunch. So Van, can you talk about your technical methods?
Sure. But a comment on someone that I respect, David. A lot of people know that I got a degree from Michigan, but I'm secretly an Ohio State fan. So go Bucks. But when it comes to technical analysis, I don't talk too much about it, but I do like what David mentioned on the point and figure charts. There's no time, there's no noise. It's just vibes and boxes. It's kind of like market textures after three
Mm.
martinis. If it breaks a triple top, I break a chair. So
So Van, weren't a couple of your biggest successes? I think you had the chart upside down, but you didn't realize it, and you were it looked pretty good that way, and you wound up making a shit ton of money. Like, you don't want to tell people at the time that's how you did the trade, but you told me that one time, Van.
well, I think the one that probably worked the best was that I didn't realize that when you spill Drambuie on your chart, it smears the ink. And mercifully, one of the charts that probably showed an head and shoulders, I read it as an inverse head and shoulders and just got lucky. So,
So so Van,
but George,
yeah, go ahead.
you know, all this stuff about the war, right, had me a little bit concerned, and that's why I hadn't been around. I was actually up near Gnostic. I think I was up in the Canadian Rockies to commune with nature in search of an oil play, but I ended up accidentally confusing a moose for a macro strategist. So about midway through my fifth glacier chilled bourbon, I overheard him mumble, West Texas arbitrage near Banff. So he said he had a deal, but the deal turned out it was just a bunch of trees that were piled up by the beavers, but it looked like oil barrels to me. So I traded some maple syrup futures and infused it with some Crown Royal and some glacier runoff and called it the Rocky Mountain Risk On. But uh, I'm back and I'm hungover and I hedged. But now I'm stuck with Gary the Moose as my energy strategist. So,
So,
and then
so
come to find out, I make it back in the cell phone range, and Trump said it's time for peace.
oh
I
God.
misheard it and bought a truckload of frozen peas, and I called it a commodity play. So now I'm stuck with all these legumes, and I'm very short on clarity here.
So Van, when you were working with Big George, like Soros, he was a big charts guy, right, Van? I mean, he the fun of I mean, if the chart looked good, that was like half the battle with him, wasn't it?
I think that where we people got confused about where George and I, looked at the charts with I looked at charts like I looked at the bar tab. I looked at them a little confused and suspicious and pretty sure someone else was paying. And every time I tried to pass the bill to George, he passed it back to me doubled. So George definitely relied on the charts maybe a little more than I did.
Yeah, there you go. There you go. But he was also quick to take credit when it worked, right? And not so much when it didn't work.
I think that was probably the biggest reason why I had to go out and kind of do my own thing. He took credit like I take tequila shots fast and loud and with zero memory of who actually did the work. So you can chart that, George.
So Van, we're so glad you're back. I mean, take it easy, man. You got to sleep this one off. So really appreciate you coming in, Van, and you be sure to come back soon.
Mm-hmm.
Yeah.
Will do.
So yeah, all right, you'll be good. But it's only Tuesday. It's only Wednesday night, Van. So Thursday's still in front of you. So take it easy, man. The weekend's a couple days away. So David, everyone's got their own methods. Van is well accomplished. He's so we're honored to have him stop by. So David, what do you? I'm just curious. You've been at this for a while now. What do you wish you knew? What have you really learned? In all the years you've been doing this, what are some of the like? What do you wish you knew when you were starting out? It's just believe in the charts, or put your narrative aside. Like, trust your lion eyes and don't try to overrule what the charts are telling. I don't know. I'm just throwing stuff at you, but because we all try. We're all our biggest enemies ourselves. We got perceptions and beliefs, and
Yeah.
so for you, what would you say, especially if you're trying to help people in the room who don't have your experience, and we learn from our mistakes and whatever. So, I mean, I'm happy to talk about all my mistakes. I made so many of them, but what would you say? What would you say, David?
Yeah. It's funny. I've talked to a lot of my sort of friends in the technical analysis community about the normal life cycle of a technical analyst. And I think what happens is you start with a very simplistic process that doesn't work, right? And you realize that you need a better sense of what's going on. You need more tools and techniques to use. And so
Mm-hmm.
there's this period that happens, and I to directly answer your question, I wish this period was a shorter period of my career, which is you start to overcomplicate. And eventually you have so many things happening that you have this illusion of having a good sense of the markets when you're really just confusing the issue. And a great I have a story to share on this. This was years ago. I was on the floor of boy, I think it was Citigroup, was one of the FX desks in New York, and I was with Bloomberg at the time. So my job was to walk around as a young technical analyst and just see how people were using charts, answer questions about different tools and techniques, and kind of just help the traders improve their technical game. And I walk by and I find this one trader. He had probably four monitors in front of him, and he probably had, I stood there for a second, he probably had like 70, 75 different technical indicators on his screen at the same time. So he literally, as I'm looking through, I'm like, I think he has every indicator we actually have on the Bloomberg platform. I think he's showing it on his screen right now. So I watched him trade for a little bit, and then I introduced myself. I said, "Hey, I'm Dave Keller. I'm the technical analyst at Bloomberg. Like, what you're doing is crazy. Like, I can't believe how you're able to synthesize all this data. Like, what can you tell me? Like, how you're doing? Like, what are you doing to make sense of this?" He said, "I have no idea what any of this stuff means." He said, "But
What?
the head of the desk will walk by and say, 'Wow, that guy's all over the markets. Look at that.'" And so you find that having a bunch of stuff, a bunch of lines, a bunch of indicators, a bunch of techniques gives you the illusion of having a good sense of what's going on, but you're usually just overcomplicating the issue and confusing it. And so one of the things that you then the next stage you get to, which thankfully I'm in now, is you start to simplify and you realize what are the tools I need to really understand what's working and what's not. What are the tools I really need to make sure that I hold positions long enough and don't sell too early? What are the things that I need to make sure that I don't wait too long to add a position and miss the whole thing on the way up? And I think in the end, you usually come down to it's not as complicated as you need it to. So I would encourage people to really think about not all the different things that are out there, because there's a fire hose of information we have as traders or as investors. It's focusing on the signal and focusing on what's really going to help you understand things. I think that's one, is to simplify. The second thing, which I learned earlier in my career, was the importance of consistent routines. I had a very kind of sporadic, just jump at whatever was moving kind of approach for years. And that's probably from working with a bunch of, hedge fund traders and short-term traders who are just trying to just react to any little thing that was moving. So it was all about just having real-time data that was fluctuating as quickly as possible. And I think what I've learned, and I learned this from going up to Fidelity and saw some of my analysts every Tuesday at 8:30 a.m. They would print out the same set of charts, and they would sit in the same conference room in the same chair, and they'd put their coffee over here, and they'd go through the charts like they did every Tuesday at 8:30 a.m. And I
Hmm.
realized the magic of their investment process was not that they just come up with some great holy grail indicator or technique that worked all the time. It's they just consistently applied the same kind of tried and true methods, but they just did it in a very consistent way. And that helped me to develop a morning routine, which I to this day do every morning first thing, a weekly routine that I do every Sunday morning, and a monthly routine. And by sticking to those, I've had a much better track record of following the markets, of understanding changes and not missing opportunities. So I would say, I always tell people a consistent but imperfect process is way better than an inconsistent perfect process. Having the most ideal decision making plan is not going to help you very well if you don't apply it consistently. I would opt for consistency and a less optimal set of decision making tools, and then improve on that over time, right? That's something you can always upgrade, but get in the habit of looking at the markets in a similar way, in a similar approach at a similar time, and do that consistently. And that's been one of the biggest lessons I've learned over my career.
That's really well said. And we'll go to TX in 1 second, but before we do that, and then we'll go to Gnostic after TX. I'm sure along the way you probably met with or a client of Dennis Gartman.
Sure.
And Dennis has 22 trading rules. But one of them was, I believe, keep your system simple.
Mm,
Complexity breeds confusion. And, you know, John Roque has a wonderful story about that. And I have to get John back in here to tell the story. But it was something along the lines of he was talking, I think, to a former military intelligence guy, some big name when he was working on the buy side. The guy would come around as a consultant. And John always makes a difference between having all the information or just enough information.
yeah.
And when you get into things like pattern recognition and stuff like that, it's like, it's the 80/20 rule. Like, there are certain key things you need to look at, and you'll get 80% of the way with there you need to. And then it's like the last 80% of the effort, you don't, it's the marginal return on invested time spent, goes down precipitously. And so
Yeah.
I'm totally with you. I think consistency. Okay, we'll go to TX and then Gnostic. TX, good to see you. Please unmute yourself, TX.
And likewise, thank you, George. Just gonna fire a few questions and don't feel the need to get into the weeds because it's just gonna be boredom for people. But I'd like to have your views nonetheless. First thing, since many people now look at technicals and they know what a head and shoulders is, or inverse head and shoulders, or a H pattern, or whatever, uh, don't you reach the point where it's kind of that stuff doesn't work anymore because
Mm.
everybody's looking at the same thing and knows it, so it's bound to fail, and you don't need to get into the weeds. Yes or no will be totally fine.
Ooh. No, I don't think that's an issue. But and I'll give you the quick version. I mean, 100%. I mean, I hear you. That is a question that was first raised to me about 25 years ago at a presentation I did. I think it was at Lehman Brothers or something. And someone asked that, and I've had a version of that question this whole time. During that period, though, I've been able to have a pretty successful career looking at technical analysis primarily. So my own experience would say no, that's not a very real issue. And I would say here's why. I would say there are certain techniques that are valuable because so many people look at them, right? The reason I would say the 200-day moving average
Yeah.
is not statistically the most meaningful thing you could ever use to analyze a chart, but so many people are looking at that as a level where they expect support or resistance.
Yeah.
So I think there's value in following, right? There's a self-fulfilling prophecy. The other thing is the reality of the markets is that there are still, even though it feels like everyone is looking at a certain technique or identifying a certain pattern, there are just hundreds of thousands of millions of investors that will never look at a head and shoulders pattern. I truly believe that. As much as that feels like that should be a real issue, it isn't. And I think that probably goes back to the fact that the momentum factor has been a known phenomenon in the financial industry for years. Hedge funds have made, incredible successes out of capitalizing on that. And even though we all still know about the momentum factor, it still works to this day. I mean, it still tends to outperform. So I think it's probably related to that. I don't see that as real as an issue as we probably might be afraid it would be.
Okay, very quick, another two or three questions, but very quick. Do you think you can apply your analysis or technical analysis in general to Microsoft and to 10 million OTC stock that trades once in a blue moon kind of thing? I'm kind of stretching it, but you get my point.
Yeah, so technical analysis is only as good as the data that you have. So very, you have to have certain, thresholds to be able to trust that the data represents the trend, right? Represents the interplay of buyers and sellers. For liquid names traded in the US, small cap, mid cap, large cap, it's a non-issue. When you get to penny stocks, when you get to frontier markets, that are not traded as actively, when you get to ETFs that don't have a lot of liquidity, I would say a lot of technical indicators a lot less valuable just because there's less data. So there's a threshold to enough data that makes indicators work. And as an experienced technical analyst, you can immediately see when you bring up a
Hello.
chart, yep, that's not enough data to do it. And you'll see it a lot if you look at like an hourly chart, like a 5-minute chart. It just doesn't trade often enough to really
Right.
get enough data for that.
Okay, very quick again. George was mentioning pattern recognition, which relates, at least I believe, to fractal analysis. Do you believe in that?
For sure. A lot of the technical toolkit is built on the premise that there's a fractal nature to market activity. Elliott wave theory is probably the most commonly, documented, that sort of argues that there's a fractal nature, and from short term to very long term timeframes that there will be patterns that move. I have found that while that in general is true, I have found that indicators and techniques have to be adapted. So if I was looking at a 1-minute chart of the E-minis, or I was looking at a monthly chart of Microsoft, I would probably use a different set of tools and techniques to understand what was happening. But I think the general premise, which is that patterns have value from very long term to very short term timeframes, and there's a relationship, I think makes a ton of sense. And particularly looking at cycles, I think that's hard to disagree with.
Okay, last question, because that I really don't have the answer and I know nothing about it. And most people hear the name or the word, but they don't have a clue. When the tech guys and talk about market structure, what do they talk about?
Ooh, that could be a number of things. For me, the market structure, I would describe that as the players that are actually transacting and how they relate to one another. So the structure of the market is where trades are actually occurring, the liquidity, meaning when you want to buy or sell something, what happens, and what's that mechanism that those orders are related. The mar and that's how I would think of it. And for me, market structure has been probably the biggest change that's happened in 25 years. I mean, when I started in the industry, decimalization was still a relatively new thing. The euro had just come out, and so just the structure of all of those markets evolved very quickly. Dark pools weren't a thing, and then now they're very much a thing. George, you actually posted on your social media earlier today. I saw, looking at the percent of volume that was active management. It used to be like 80%, and now it's like 10%. At large firms, right? Most of your trading was done, discretionary trading, a buy side trader picking up the phone and pulling a trigger. Now, I mean, probably 90+% are algorithmic trades would be my guess, right? Which are just done automated and trading around a VWAP or something like that. So for me, market structure means the way that different market participants are able to relate to one another. And I would say the impacts, a lot of those changes are still difficult to read. The most significant one recently, I mean, as an aside, would be zero DTE options. I
Yeah.
think that's profoundly changed the dynamic of the options market. It's the most liquid part of the options market. Indicators that we've looked at for years, like the VIX, you can't tell me those have not been affected. The put call ratio, you can't tell me those haven't been, in some ways probably profoundly impacted by the fact that there's this new part of the options market that's incredibly liquid. It's like tariffs and other things. I think the impact will probably be realized down the road. When we look back, we'll understand what has changed so much. But it is a very real issue for sure.
Mm. And okay, the last one for sure. You were talking about divergencies. I mean, we have companies that are making money, that are paying nice dividends, that are real businesses, like I don't know, very boring Campbell Soup, PepsiCo, some chemical companies, and I have a few friends that own some of those, and they pay you 6 or 7% dividend, and they're just going straight down. They 50% of their eyes, and on the other end, you have companies that burn weeps of cash. Roblox being an example. They don't
Mm.
make money. They've never made money, and they go straight up to the riots, and they up 100% over the past 6 months. So you have divergencies all over the place.
100%, right? And I would say that, I mean, that divergence that you mentioned, and I think what you have to remember is, with a lot of dividend paying stocks, there's a big disconnect between what that actually means for you as an investor and the reality of it. So if you own Campbell's probably pays like a 5% dividend yield now, I would say, because it's
Yeah.
come down so much. I mean, just the fact that the yield is so high is not a great sign, because I was always taught, don't confuse the bottom of the page with support. And a chart like CPB has made consistently new 52-week lows every month since March, probably. So for me as a technical analyst, that's something I would not even remotely touch until you start to find some stability. So at some point, charts like Campbell's become so cheap that people see it as a great value. At some point, people see Roblox as being way too expensive and overvalued, and the buying power dissipates. And I think there are very easy technical analysis tools we could use to determine exactly when that inflection point starts to happen. But it's not happening today, right? Those trends are
No, no,
persisting. Yeah.
no. But just because you can say, well, people are probably gonna keep on eating some soup, and Roblox is probably gonna keep on losing money. So there's a point at which it really doesn't make sense. But anyway, thank you very much for answering those questions.
No, for sure. Thank you.
Thanks, TX. Gnostic, did you have a follow up? Not sure. Gnostic, you
Oh
still
yeah,
there?
I'm there. I had to go off and
No
do some
worries.
stuff in the meantime. So David, one of the things that annoyed me about Bloomberg was, here's all of the indicators, everything else. For God's sakes, could I just pull them into some system that said, these are all giving you basically the same signal, or within a certain percentage the same signal, and
Yeah.
just tell me when one of them steps out of line, please. So I don't have to have all
Mm,
those flipping things on the screen all the time,
yeah.
and then flip through all the stocks. I mean, we're trying to follow several hundred stocks simultaneously to sit down and do stuff. And Bloomberg just like, I had an intern come and work for me, and the guy was just, he went, oh my God. And, so you got your business degree, you got the rest of the stuff, all the rest of the stuff, you got a professor, go talk to the professor. Here's all the professor starts feeding them all this shit about, various things to sit down and do analysis. Now, Bloomberg has everything on it. I mean, just pick this out and pick this out. We had, I think, 8 screens up for this guy, and he's just plopping them all away. Absolutely nothing out of them. And I'm looking at him going, what the plank are you doing? Well, this is what the prof said to do. And I said, tell your idiot prof to get his ass in here. The guy's like, I can't tell him that. No, you use those words. My boss says, get your fucking idiot ass in here to take a look at what you're doing. And the prof
Oh,
shows up. This was an old prof of mine. And he walked
wow.
into the room. He took one look at me, and he's looking at his student, and he's going, oh, fuck. Now I know why you cursed. I figured, wildest dream, I figured only person I know that would call me a fucker and get your ass in here. Yeah, he came in. I sat him down in front of Bloomberg and said, now you clean up this fucking mess. You made it. You fucking clean it up, you asshole. And the guy's sitting there going, that's not my job. It is your fucking job because you screwed up this guy.
Oh boy.
And the prof is
Oh
sitting there
boy.
looking at me going, but I teach business analysis and here's the, you have every freaking tool you ever imagined in your wet dream on this machine. It's the best assistance machine you can find. You have a problem. Here's the headset. You phone them up. You
Mm-hmm.
ask the guy how to do it. Absolute best in the world. I've had a Bloomberg for years. Best help ever you ever wanted to dig. You can get every question answered. 724. And I've dealt with Reuters, Thompson, like the whole set of them I've had on my desk. I've even had the Thompson people out, the Reuters people out who go, oh, don't you like our system? I said, here's Bloomberg. Here's this. I want to do this. You figure out the answer on that. I'll get it to you in a few
Yeah, but and
seconds.
yes, no, so let me just interrupt on one thing though. I agree with you on the data sets that Bloomberg has, but I'm blown away. To this day, I don't understand, as powerful as Bloomberg is, as good as it is, their charting sucks. I mean, I
No
would take
kidding.
stock.
No freaking
So
kidding.
Nasi, let me ask you. So for everyone, and by the way, David, this is a tease, but what was that? Is that promo code George to get 50% off stockcharts.com right now? I want to make sure I tweet that out. Is that what you're doing, David? Is 50% or 30% for all the viewers? No tease. David,
Well, they
why do you think?
Bloomberg should put up
Why?
David's stuff for Christ's sake.
Yeah, 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 yeah.
Right.
But David,
Yeah.
like, why is it like, little old stockcharts.com has got charts a million times, technicals a million times better than Bloomberg. It just
Yeah.
blows my mind.
I
What's behind it, do you
Yeah,
think?
so I worked at Bloomberg back in the day, and but before we actually started to change the charting platform, that's when things were really ugly. That was because
Mm-hmm.
I mean, it was just an antiquated system, and the
Yep.
But
problem
David,
we
you
had.
have the you've got those little shitty, multi video terminals that you can't see anything in.
Oh yeah.
Okay,
Oh yeah.
that you couldn't do a chart on that thing because it was all
Yes.
character oriented. I mean, like
Yes.
just so nobody looked at charts because it was crap. That little
Yeah.
character chart just would not do it. So nothing in Bloomberg was chart oriented. Absolutely
That's
nothing
right.
because it was
That's right.
totally useless.
That's right. And the technology's gotten better. The problem is the infrastructure with which you're building charts in a platform like Bloomberg. You're fighting the legacy technology that was still
Uh,
built. So I remember, looking years ago and wondering why we couldn't make a particular chart way better. And so one of the programmers invited me down and showed me the page of COBOL code, no joke, that was
mm,
still running one of the most heavily used functions on the
mm,
Bloomberg platform. So it's just the problem was the foundation upon which you built it. So stock
got it.
charts was built as a series of images. It literally creates a JPEG every time you want to do something on the chart. So it's crystal clear. It looks good. It's great when if you export it, it looks good there too. And other platforms that have come up more recently have the benefit of using the newest technology as a starting point. So it's the
Mm-hmm.
legacy technology that bites a lot of the big
Got
providers,
it.
and that's still an issue for Bloomberg, unfortunately. But I would
That
agree.
makes
I'd
So
love to see it be better.
that makes a
I
lot of
think
sense.
I think Bloomberg's problem with charting is that it's kind of like dating a rich alcoholic. It's expensive, confusing, and you swear like my ex it used to look better in the
Excuse me.
'90s.
Van, you woke up. I thought you were passing out for the night.
Oh God, I
All
love
right.
Van's jokes. Holy
I,
Jesus.
I know, I know, I know. But Van's. It depends on how many he's had, because he can. So anyway. All right. Listen, David. This is beyond the call of duty. We're what, an hour and 20 minutes into this.
Yeah.
So, I hope you've enjoyed yourself and you'll come back. We've certainly enjoyed listening to you and learned a heck of a lot. And like I told you, it's not as bad as going to the dentist. So, come on back. This has been great, and I want to thank everyone for TX, Gnostic, Van, everyone. This has been great. And
Well,
Dave, I hope we'll see you again in a few months. Yeah.
David,
Cheers,
follow me so
George.
I can send you a note, please.
We'll do Gnostic. Yeah, we'll do.
Take care.
All
Be
right.
good. Good
Take
night,
care,
Good
everyone.
night,
Good
guys.
night. Bye
everyone.
bye. Bye bye. Good night. Good night.